Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about East Buy Holding Limited interim report. East Buy Holding Limited offers a diverse range of businesses and services. At its core, the company engages in live streaming e-commerce for private label products in China through its live streaming channels, including East Buy Beautiful Life and East Buy Private Label. In addition to this, the company provides agricultural products under its own brand. Beyond these core offerings, East Buy Holding Limited also offers a variety of services. These include software and technology solutions, education advisory, human resources and related services, tourism services, supply chain management, and online education for college students and working professionals. The East Buy stock price has seen a significant increase of over 35.58% in the past year, with a notable surge occurring in July 2025. This substantial rise was primarily driven by strong investor sentiment surrounding the company's self-operated product business and the expansion of its in-house platform. In early July 2025, East Buy's shares experienced an impressive increase of over 212%, reaching levels not seen since March 2023. This upward movement exceeded the specified 35.58% threshold, marking a major turning point for the company's stock price. More recently, East Buy announced positive interim results for the 6 months ending November 2025, reporting a swing to a profit of $139 million from a loss in the same period last year. While these results indicate a positive financial trend, they do not explicitly detail their impact on a single day or short-term increase over 35.58%. East Buy Holding Limited market capitalization of $23 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that East Buy Holding Limited holds a significant advantage in their industry. East Buy Holding Limited trades at a higher price-to-earnings ratio of 22.10 times and a higher price-to-book ratio of 4.03 times relative within the industry. Despite the industry trading at relatively low valuations, the stock commands a premium over its peers. Unless supported by a strong economic moat, the company might not appear to be the most attractive opportunity in the sector and is likely fairly valued at best. The balance sheet appears very conservative, with liabilities representing only 16% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth for a company can be attributed to several key factors. Firstly, the expansion of private label products and live streaming e-commerce has been instrumental in driving revenue growth. The establishment of the East Buy platform has also contributed significantly to this growth. Additionally, diversified cooperation with third parties has helped to increase revenue. The company's focus on product iteration and cost optimization in daily necessities categories, such as sanitary pads, has also led to increased revenue. Furthermore, the introduction of new products with high demand, same-day delivery capabilities for top cities, and increased customer satisfaction rate have all contributed to revenue growth. In terms of digital marketing, the use of generative engagement optimization, GEO, personalized product recommendations, AI shopping guides, and real-time inventory alerts has helped to drive traffic conversion efficiency. The company's focus on AI empowerment in customer service has also led to proactive creation and user retention. The data shows that revenue from app has increased by 20%, while revenue from live streaming channels and private label products have seen growth of 17% and 18.1% respectively. Overall, the company's diversified approach to revenue growth has been successful in driving business expansion. The net income of the company underwent a significant transformation, shifting from a loss of RMB 96.5 million to a profit of RMB 239 million. This substantial change in net income is a testament to the company's ability to turn its financial fortunes around. A closer examination of the company's profit margins reveals an even more impressive story. The gross margin, which had remained relatively stable, saw a notable increase due to the introduction of private label products and the expansion of live streaming e-commerce business. This strategic move not only boosted revenue, but also helped to improve overall profitability. As a result, the company's overall profit margins increased from -12.3% to 28.6%, indicating a significant improvement in its financial health. Management is emphasizing a customer-centric approach by implementing initiatives that enhance customer experience. This includes adopting a multi-platform strategy to expand reach and increase brand awareness, with a focus on the Douyin platform for efficient traffic delivery and conversion. A dual-core content ecosystem is being built, integrating products and culture to create a cohesive brand identity. The company is also prioritizing talent training and organizational structure building to maximize employee potential, while identifying bestsellers through user research and data analysis. Overall, management's strategy focuses on customer centricity, digital expansion, and internal development to drive growth and success. And there is no significant activity to report on acquisitions and divestitures. The company has not made any notable purchases or sales of assets, businesses, or subsidiaries during the period under review. This indicates a stable and focused approach to business operations, with no major changes in its portfolio or structure. As such, there are no new developments or transactions to highlight in this regard. The company's financial activities over the past period have been notable. One key aspect is its decision regarding shareholder returns. In terms of dividend payments, the company has chosen not to distribute any dividends to its shareholders. This means that existing shareholders will not receive a direct return on their investment in the form of cash payouts. On the other hand, the company has engaged in share buybacks, purchasing shares worth $11,951,000. This move is aimed at reducing the number of outstanding shares and potentially increasing the value of each remaining share for existing investors. By buying back its own stock, the company can also signal confidence in its future prospects to the market. Concerns have been raised regarding inventory buildup and potential disruptions to the supply chain. A specific instance of this concern is highlighted on page 9, where the issue is explicitly mentioned. This suggests that there may be a pressing need for attention to be given to managing inventory levels in order to prevent any potential problems from arising. That concludes the financial summary for East by Holding Limited. Feel free to comment below, and I will be happy to answer them when possible.